Bill Dudley, markets are moving. The litmus paper of the system, the 10-year real yield, has gone from the bottom 83% up to the pre-Great Financial Crisis level of about a 2.05. How do fancy people like you interpret where the real yield is, how far the real yield has come, and how it nears what seems to be some form of historic normal?
Well, I think it tells you that the Fed is finally getting its arms around making monetary policy tight. Chairman Powell talked about how he needed to see real yields positive throughout the yield curve, and the Fed is moving pretty quickly in that direction. And 75 basis points last week, and they're promising another maybe 125 basis points before the end of the year, taking the federal funds rate well above 4%. So the Fed is catching up. And I think the question at this point is, will they stay the course until they've actually finished the job to get inflation back down to 2%? Powell says he'll do that, but whether the rest of the FOMC will come along with them, I think is an open question at this point.
You, like Richard Clarida, who joined us on Fed Day, know the mathematics, the physics of modern economics, and then you discard it to real-world application. You did that at Goldman Sachs for decades and then at the Fed. I want to talk about the inertial force in this odd word, overshoot. Is it a requirement or is it efficacious that a central bank overshoot a given target?
Well, ideally, you don't overshoot. You do just enough to achieve your objectives. But as you know, monetary policy has a lot of long lags in terms of its effects on the economy, and it's hard to judge those effects in real time. I think the Fed is probably going to ultimately overshoot a bit because they've said that the risks are skewed. The risk of doing too little is much greater than the risk of doing too much, because if you do too little, you end up in the 1970s with a more entrenched inflation problem, and then you have to do even more later. So I think this is the consequence of the Fed being late. If you're late, you have to catch up. If you catch up, you probably are going to overshoot. If you overshoot, you're going to have a recession. I think where I would fault the Fed right now is I don't think they've been realistic about the pain that they're actually going to cause. If you look at their forecast last week, the unemployment rate climbs a little bit. It climbs up to 4.4%, and then inflation melts away. I don't think it's going to be quite so simple as that. There's never been an example of the unemployment rate rising from 3.5% to 4.4%, 0.9 percentage point rise. If it rises more than a half a percentage point, every time that's happened in the post-World War II period, the U.S. has ended up in a full-blown recession. And the smallest rise in the unemployment rate in those situations is 2 percentage points. So I think the Fed is understanding the pain involved. What worries me about that, then, is that people, when the pain actually arrives, people will start to pressure the Fed not to follow through.
And this is the point of the column that you wrote today, that there seem to be some doubts in your mind and in markets' minds right now, if the market had a mind, that the Fed is going to stay the course. What do you think they have to do to come out and say they're going to stay the course? Or do you think they're not going to, that they're going to pull back on some of the rate hikes, say if unemployment rises above 4.5%?
Well, I think Chair Powell is committed to staying the course. I think he's studied history and knows the consequences of not doing enough. But whether it can bring the rest of the Federal Open Market Committee along with them later. I mean, right now it's easy to be tough, right? Because everybody wants to get inflation down. The labor market is still very strong. And so the pain hasn't really materialized yet. A year from now, when the unemployment rates will quit considerably higher, the economy has slowed, inflation's come down a bit, there's going to be people that are going to start to argue, do we really need to push inflation all the way back to 2%, or can we take a break now?
And how much is this going to be a political pressure on the Fed?
Well, I think the Biden administration will be pretty good about guarding the Fed's independence. Typically, if an administration starts to pick on the Fed, that just unnerves financial markets, and that makes the central bank's job even harder. So I would be surprised if the Biden administration started to attack the Fed. But you already are hearing cries from the left wing of the Democratic Party about how unfair this is, that low-income workers are going to be put out of work, as if there's some alternative. The problem here is that once you're late, you have to catch up. Once you're late, the unemployment rate has to go up. There are no other alternatives. And so it's not as if the Fed has a better path to achieve better outcomes. They need to do what they need to do to get inflation back down. It's just going to be difficult.
If we see services stabilize and maybe reduce, if we see goods come down to the goods disinflation or deflation that we saw pre-pandemic, I guess that means we come back towards John Taylor's 2%. Are you wedded to 2.0%, or can Bill Dudley construct a new normal at 2.8, 2.9, 2 Adam Posen. Where do you stand on that, Bill?
Well, I'm not sure, Tom, if you're talking about the real interest rate or inflation.
Well, I'll go either way. I'll let you make it up. But
Okay.
to me, it's just it's a level that we're aspiring to get to out there.
I think, yeah, there are some people that say the Fed should raise their inflation target, but I think that's a bad approach right now, because that's like moving the goalpost because you can't achieve your objective.
Done that.
So I think that would undercut the Fed's credibility a lot. And I think Powell has been very clear that his pursuit of 2% inflation from his perspective is unconditional. Whether he can bring the rest of the FOMC along with him when the job starts to become more difficult is really a fundamental question. Right now, markets basically believe Powell. Inflation expectations stay well anchored, but the pain process that's about to unfold is just begun.
That's the domestic pain. The international pain we're witnessing right now, Bill.
Well, that's happened already. Yes, absolutely.
So I wonder, Bill, how you think they should respond to that, if at all.
Well, the reality is they're not going to respond to that, because at the end of the day, monetary policy in the U.S. is about what's best for the United States in terms of the Fed achieving its U.S. inflation and output and employment objectives. Obviously, this creates a lot of pressure on the rest of the world. The stronger dollar holds down U.S. inflation. A weaker foreign currency increases inflation. So the flip side for other countries is much, much tougher.